Hello, my name is Brian Overby. Welcome to Options Guy TV. And well, interesting week we have going on. Uh, we looked at Synopsys as a time spread, and it's actually worked out quite well. Big announcement with them and NVIDIA doing some B2B work, honestly, is really what it was all about. And the building out of industrial machines using AI to make products, quote unquote, perfectly, right? You need to be 99% correct on everything that you do. And so both of the CEOs met on CNBC on Monday after the announcement, and the stock has shown a lot of strength ever since then. And today we're showing it up $5.24. Now, on Monday, and I'm kind of glad we still went through this, I mentioned that Synopsys is announcing earnings on the 10th, and let's do a time spread writing into that announcement. Now, the downside is that Synopsys is a $454 stock, and partly because of that, but just liquidity in general, it's got wide bid-ask spreads. But the more expensive the underlying, a lot of times the wider the bid-ask spreads will be, and that's okay in some events, like the S&P 500 index, the good old SPX. The SPY is 1 cent wide, like extremely tight markets on the options and on the ETF. But Synopsys is just fairly wide, and that was my only trepidation when I was putting the trade together. But the market has overtaken that because Synopsys has gone up so much. So if we pull in, and let's pull in, and first of all, go to the Tradier Pro software, and we'll see that we have three really strong candles after a gap up. So we come down here, we bounce around the 400 level. And I can go out a little bit further, and I'll kind of show that this was a strong level of support. Hit it here, came down, almost touched it there, bounced there, and then above the 20-day, bump up for a second against the 50-day, and now we are going stronger. Next stop, I think it would be the 200-day. And let me move this back. Let's go 2,000 days back. And you see this whole area where we're bouncing at 1, 2, 3. Now, if we broke below that, that would be scary, because then you're looking all the way down here, right? But it didn't. It held, and we know that there's major news out on it, on the underlying stock. But like this area, there's just a whole bunch of congestion, and I think it's a fairly strong area of support. Now, earnings date, it's right here. There it is, on the 10th. So we got the 10th earnings, and I'm pretty sure it's a California-based company. So I think it's after the close on the 10th, but that doesn't necessarily matter, because we're probably going to end up getting out of this trade and not riding it to earnings, because we've had such a strong move to the upside. So here is the trade that we did. Let's go back and look at it. Synopsys, we did well, you could call it, it's a diagonal spread, but it's really, I think of it as a time spread. Diagonal spread is the most correct term, in that we didn't do the same strikes, and we did two different expirations going on into that earnings event. The trade that we put on is, let me pull it. I'm actually just going to pull it over here, because we got the profit and loss graph that looked fairly good, and everything that goes along with it. So here we go. Go ahead. The 19th is the expiration that we did. So we went one expiration beyond the earnings report week, and we went out to the 19th. The market was at 433 when we did the trade. The market that we were shooting for is 450. We bought the just in the money. Well, it's not now, it's just in the money. We bought the 450 call, but then we sold the 452 call. And to me, this is all about delta, because if the short-term option gets in the money, the delta will explode via gamma. Gamma says that it's going to explode. And so we're going to buy something that will already have a decent amount of delta. We bought the 450. By the time it gets to 452, this becomes an at the money. This becomes an in the money. Delta is going to go fast, and it's going to keep it more neutral. Now, I prefer to do it this way, but it's hard to do on lower price underlyings. But I always like to do trades where I know you're 99% sure that implied volatility is going to increase on the expiration that occurs after earnings, and more than likely on the shorter term option contract that expires before earnings, implied volatility is going to go down. So it's counterintuitive in that you are buying the pumped up vol because you think it's going to continue to get higher, and you are selling the pumped down vol because you know expiration is approaching and that there is time that's going to decay. So right now the market is, oh, this is a screenshot. Yeah, it doesn't make sense. I fooled myself. So when we put the trade on, it's $433 is when we put it on. We're right around 452 at this point in time. So we have to do something with this trade, or we're going to get pegged, and the 452 option is going to start hurting us more than the 450 option is helping us. So this was a great scenario, honestly, that we put together, popping that back up. And let's set up the trade and see where we're at. Now we're at 456. So we need to move quick. Once again, it seems like whenever I do the show, the market just won't behave whenever I do it and just let me finish my show. But now it's already moved up. It was up 3 when I started looking at it. Now it's up 7. All right, here's the trade. Let's delete this option contract. Let's delete them both. Okay, so we bought the 450. I went here and sold the 452. Net debit of 18. We put this trade together for 15.18. $15.18. We're at $18.40. So we're doing excellent on it. And that's the other thing about these type of trades is it's like a butterfly. You saw the profit and loss graph. It's a wavy butterfly, right? Comes to a precipice right in the middle, right at that strike. And we're up $3 on the trade. So right now, because the market has moved higher than our short strike, 455.46. Now, and it's already dropped $1 since we even pulled up the chain. But because of that, and it's happened in 2 days, we're just going to close it out. And we're going to take the 1840, just moved a little bit. We'll call it 18. Let's put it at 18. And we'll say we're done on the trade. And that would be our order. So you'd flip the script, buy to open, sell to open, and you'd sell to open, sell to close, buy to close. These would be closing orders, but it won't let me do that because it's a fake trade. All right. There you go. That's simple. Ta-da. 3 days. Now, if we could get to Friday, right, it moved fast, and we'll take, $3 in 2 days, not that much of a concern, because also on top of it too, on the downside, you had the spread on, so time decay is going to kind of offset any loss on the downside, because you're going to be selling that shorter term option contract that wants the market to go down. You still have the risk of the net debit that you paid for the trade, but you could actually even come out and sell another call against it. I like the time spread scenario when you want to get bullish on an option contract and you put the trade on. If you get the benefit of being profitable before the earnings, that's great. And if not, you can always ride it through earnings and let that shorter term option contract expire. And then you own the longer term option contract at a little bit of a discounted price, but you still paid up for the increased implied volatility. I like the scenario that happens with that, with horizontal time spreads, otherwise known in this case as a diagonal spread, because we did different strikes in two different time horizons. So let me think. Is there anything more that we can do with synopsis? I still don't look at these markets. Oh my gosh. 11 by 640. Yeah, we need to just stop messing with this underlying. Unfortunately, it's just too wide. And that doesn't really make a ton of sense to me. I mean, there's not a ton of open interest over here, but the stock is obviously in the know, and it's a deal stock that's happening, and there's a lot of volume, and I just can't quite comprehend why these markets are just so wide. I mean, open interest isn't huge, and I don't know why open interest shouldn't even. You got earnings, you got a lot of things that are happening in this underlying. Kind of surprised that it's as illiquid as it is. All right. Next thing that I want to look at, I talked a lot about last week, or going into the holiday trading sessions, where we didn't have trading on Thanksgiving, and then on Friday we had a half day. And that's usually my start to, well, the end of the year is coming, and I would like to clean up my portfolio, just like a lot of the hedge fund managers do, where you're selling some winners and selling some losers, and you're maybe trying to offset, trying to battle some tax implications, or you just, it's time. Let's get rid of some stocks and just do a little house cleaning. And so the way that I like to do that is to sell call options. So on some of the underlying stocks that have made nice moves up, or something that you want to get out of, and just close that position. And I'm going to use Apple, for example. Now, Apple, was in the front and center in the initial was it Independence Day? No, Independence Day is 4th of July. Liberation Day, that all the tariffs got announced because Apple builds their phones in China. And obviously the war with tariffs is still going on with China, but it was insanely high on the initial battle, I guess, as far as the trade war is concerned, and tariffs. So Apple at 286.38, that was at 200, and it just hung there forever. So now the market is up, and has now had a real good year, Apple. And all of a sudden their AI strategy is being embraced, as opposed to people, biting their thumbs at it. So at this point in time, at 286.45, if you wanted to sell and you wanted to take a gain on the stock, the way that I like to do it is almost synthetically sell a put. This is synthetically selling a put. Buy. You own 100 shares of Apple, and I'm going to sell an either at the money, or I'm going to sell an in the money call option. And I'm going to use an expiration that happens before January, because the goal here is to try to get out of the position before the end of the year. So I'm going to look at the December 26th expiration. We have it at 285. If I sell the 285, right now, market's at 286.47. I bring in $5.48. This is time value of intrinsic value, saying that I do think that the market will stay above 285. And I want to officially sell it at, I'm going to make this 7, right? We'll say it's $7, 292. And I'm going to be able to capture that premium. And my hope is that it just stays above 285, and I'm able to get out of my Apple position. Now, you can insert AMD, you can insert Goldman Sachs, you can insert Coinbase, which has had a strong move recently after getting beat up for a while, Home Depot, whatever stock that you may have a gain on that you want to get out of, or maybe a loss. It's possible to do that too. Now, If you really want to get rid of it, you can go down to the 280 strike. So we're on the December 26th expiration. The 280 strike is 1040 by 1025. So effectively, you sell it at 280 plus 1040, but you have more chance of it getting called away, but you don't get as much benefit. This is an at-the-money option contract that's got $5.30 worth of intrinsic and everything else, or of extrinsic time value, and everything else is intrinsic or in the money. Now, in this instance, we're only getting $3.74. So in this scenario, we get that above and beyond, any dividends that we pay. But the odds of it getting called away are a lot higher because you get called away at 280 as opposed to getting called away at 285, 5 points higher. So if the market stays above 280, you get called away. A lot of people don't think about selling in the money calls on a stock that you really want to get rid of. And also a mistake that a lot of people will make is they will not pay attention to the time value. So they may come down and say, oh gosh, all right, I want to really get rid of this. I'm going to sell the 260. Well, then you're only bringing in 90 cents worth of time value. Is it really worth doing? Maybe I should just get rid of the stock. Is 90 cents worth it? Who knows? It's $285 stock, but that's not a real dividend amount saying I'm willing to take the risk of not selling my stock to try to capture an extra 90 cents. So you always want to pay attention to the extrinsic value when you're looking at doing this type of strategy. So here's what I would do if I was looking to get rid of one of my stocks. I would stay a little bit closer to the money because you're going to get a little bit more time premium. And I'm just going to click on the bid here. And the concept would be that I have 100 shares of Apple. I want to get rid of it before January 1. I'm going to use the December 26th. I could even do the 19th, just in case it doesn't get called away, right? Then I could sell another option contract if I wanted to. But I don't mind 23 days away. That's a good amount. We're getting a decent amount of premium on Apple by selling the just in the money call option. We're $1.54 in the money, bringing in $5.46 of time premium above and beyond. And we just need this stock to stay above 285. That's kind of my strategy. That's one of the things that I always like to do going into the year end. Now, I mentioned this too. If you, you have to be careful in a tax, and I don't want to get into taxes too much because we're not meant to give recommendations on taxes. I'm not a tax expert by any means, but I also don't mind another strategy where if you have very liquid underlines like an Apple, you may just decide I want to sell the stock and I want to get long an option contract. So for every 100 shares that I own, I'm going to go out and what I've been looking at, or what I've been doing in my own account on a couple occasions, is looking at the June expiration. Here we go. 200 days away, not quite, less than a year, not quite half a year, 6, 7, 8 months. We're looking at 197 days, implied volatility, 26%, a little bit elevated relative going out to June, but, and then just looking to buy an 80 delta. So if I sell some of these shares, let's hedge my risk and say, okay, I want out, but maybe I'm going to just buy a deep in the money option contract. So right now, if you buy 100 shares of Apple, that's $26,836, $28,642 right now. And that's what it would take to buy 100 shares of it. If we go down and we buy something that's close to an 80 delta, going out to the June 18th expiration, let's look at, I like this one because I'm just looking at the open interest. There's 17,000. It's 81, but you got to pay up a little bit more. But that's a good market too on a deep in the money longer term call option. It's 10 to 20 cents, somewhere in the middle there. But even if we just hit the ask, right? So that now you're taking $4,950, $4,950 divided by 28,618. You're looking at putting up 17% of the full stock price. So if I do this, I'm saying to myself, okay, on Apple, had a big move up. Maybe I'm still nervous. Maybe I'm still nervous about tariffs and where they're going to be making iPhones going forward. And I say, okay, I want to buy this deep in the money option contract. I'm going to go out 200 days and I'm going to limit my risk to 17%. Could I buy 100 shares of Apple and lose more than 17% over the next 200 days? Yeah, that could happen easily by buying 100 shares. And, replace your stock here. Could that happen in Google? Could that happen even in NVIDIA? We've already seen a couple of pullbacks, not even that long ago in NVIDIA and stocks like that. So this is an alternative. And I also think to myself, well, I'm not going to lose the 17%. So the way that I always approach these deep in the money option contracts is stocks at 285. If it ever comes down to this strike, I want to get out. Now I can say, well, if I get cut in half, I'm going to get out. So if I paid $5.50 for this, if it's trading for 25, I'm going to get out. But that also, interesting enough, ends up being the at the money price right now. So if I put this on and the market comes down to that level, I just want to sell the at the money premium. I want to get as much premium as I possibly can. And that happens to be the at the money option contracts, right? We're buying this option. We're paying $13 of intrinsic. The at the money is $25. So if it came down to this level and this becomes an at the money option, I just want to get out. And it just happens to be half the price that I'm paying. And that's just pure dumb luck. But if that happened tomorrow, this is where we'd be at. The stock would go down 35 points. We'd be trading at 250, close the position, and you should get somewhere close to where the at the money is at right now. I'm trying to say it many different ways. I know I'm being repetitive because I like to look at the chains, see where the market is at. This is where the at the money is at. If this happened right now, it would be here. Now, you could even go and say, okay, let's take away 100 days. 100 days goes away and we're at the March 20s. What's the most at the money now? So if it came down to that level and we're at 280, there's no 285. All right. Well, it's somewhere in between here. It's probably about 17 or 18, right? Because we don't have on the March expiration, we don't have a 285. But it's going to be close. It would be about we'll call it 17 and a half. So right now it's trading at 25. If the market, if it took 100 days and it came down at 35 points, I would expect to be able to get around 1750 on that trade. All right. And that's another interesting alternative as you go into the end of the year. How can I hedge my risk on that position and limit the risk and knowing where I'm at, but still it to me, it's actually another way that you can say it is it's a FOMO trade, the fear of missing out. I'm going to get out of my Apple position, but I'm a little nervous that the market still might go up. So I'm going to take 17% of the capital of the 100 shares of Apple that I owned that I just sold and got out of. And I'm going to hedge myself by going a deep in the money option contract, going out 200 days. And then I can decide if I want to get back in it again. Now, there's wash sale rules. There's some issues with all that. And it gets very particular if you're not in a retirement account or if you're buying, if it's a taxable account. So just keep that in mind. And you can look into it if you'd like. All right. I don't have much more for you today. Five Below is going to be announcing, and the state of the consumer has been good, I would say, this earnings season. And I think we're going to get more information on Five Below that, and I don't know if you're familiar with it, in that it's not a dollar store, which there's nothing that's a dollar store anymore. Nothing's really a dollar inside the dollar stores anymore. But with that said, Five Below, it means that it's $5 or below. A lot of it is techie stuff. A lot of teenagers like that. Well, it's cords. It's iPhone cords is a big thing. They do have toys from time to time, little kid stuff, and yeah, it some clothing, I think. But in general, that is the store, and I think that will, the comments on how that company is doing relative to what we've seen with Target, what we've seen with Walmart, all the other retailers that have came out. In general, the theme has been good. Target's got their own issues. Walmart had a great report and also a pretty solid forecast going forward. All right. Five Below after the close today. Going to keep an eye on that one. And we'll see you this Friday. I already had a solid trade. We'll try to come up with, October happened and the market didn't do much. Got a little bit of volatility at the beginning of November. We still got the VIX hanging out right around the 16.5 level. So it's not at lows, but it's definitely not showing a lot of nervousness in the marketplace as we head into the holiday season. And I wouldn't mind, just getting long underlyings. I think I want to get long the market going into the end of the year. And that's the way I'm going to approach it. So thanks for coming, everyone. And we'll see you this Friday at 11 a.m. for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.